Maybe let's start with you on just really the size and scope of this, of course, cash call.
Yeah, they're raising $10 billion, right? Which, if you remember from the quarterly earnings, $10 billion was about what they spent on AI spending in one quarter alone. And they're selling about 700 over million shares at a slight discount, 3.6% discount to the US ADR closing price. Now, mind you, we showed the chart earlier. The Friday closing price was already 8% lower. So a huge hit. A part of it could be the quarterly earnings, which saw a 75% decline on its profits. But this is the largest ever follow-on share sale in Hong Kong and the largest share sale since 2021. But it seems like for now, investors are not too impressed about the profitability of this company.
Anthony, let me bring you in. The block trading dynamics here at work.
It's a very heavy block, right? The size on its own in isolation for the stock is a lot. It's about 3.3 times ADV. So it'll take some time for people to get out of this if they are flippers. So the structure of the book is going to be very important, right? Who did this deal go to? Did it go to sticky kind of pension money, sovereign wealth money, or how did it go to hedge funds? That's the first dynamic. The second dynamic is we are in a very quiet period of volume here in Hong Kong, right? Volumes have been coming off a cliff into summer. And this is around, 1/3 of the entire market's traded volume, right? On Friday, we traded around 30 billion US overall. So this is going to continue to weigh on HS Tech in particular. The third dynamic is what do you hedge this with? Do you have to make space in your portfolios with other Chinese internet names, which are also struggling from a pure fundamental perspective, the likes of Tencent or JD, right? How much of those names ended up as a hedge for this Baba block? How many of those names need to be sold to make space for the Baba block? Right. So this will continue to weigh on the likes of KWeb and HS Tech. The third dynamic is what do they use this money for, right? And presumably this money is going to be used as part of its, move to net negative cash flow to raise more money on its AI push, right? To continue to spend on AI infrastructure and cloud infrastructure. And that could end up in the pockets of the companies on the Chinex, on the Star 50. So that spread might continue to widen between China's hardware and software companies.
All right, Min, talk us through what Michael Burry said. I mean, it was quite interesting what he said, right? He cannot bless this new share sale from Baba.
Yeah, he acknowledged that he actually sold his stake in Alibaba and bought JD.com instead. And interestingly, he said he believes the price competition among these e-commerce players will start to improve, and that will benefit the likes of JD.com and Meituan. But again, he cannot bless this share sale because he says Alibaba, yes, it has been making some inroads when it comes to what he calls the bloodbath in the low-cost LLM space. It's impressive, but he says that he believes the ROI is not going to improve, and that's because we did see, right, when it comes to its AI-led segment of revenue, that is still seeing losses widening despite the Alibaba models being some of the most downloaded in the world.
Why do you think such a negative reaction from investors on this
Well,
news?
to carry on with the meteorological theme, a depression has entered over the China tech sector, and that's been apparent since Tencent reported and sort of disappointed expectations. The same with Baidu and now Alibaba. Because I think, whilst Alibaba certainly has a very clear strategy, they talk a good story, this is coming at a very high financial cost to their business. When they reported results last week, we saw their capex spending went up more than 2 times sequentially to $10 billion in one quarter alone. Now, US viewers will no doubt be thinking, well, that's a fraction of what their US counterparts are spending. That's true. But from a very relative low base, it is coming up at a rapid rate and therefore pressuring their free cash flow. And also, I think a point I made on the back of the results last week, if you looked at the change in operating profit for that key cloud intelligence business, the change in operating profit year over year, profit in that business went up by $420 million US. Okay, so that's their return at a massive financial cost and investment cost. So if you look at the year as a whole, they're clearly going to be spending, close to $40 billion on capex this year. And as I said, their quarterly profit has only increased by a fraction of that. So the ROI really isn't there. And I think what shocked the market is now coming to the market with a placement. Obviously, there's a dilution. It raises questions. I think, Alibaba does have balance sheet strength. It has, or previously had a strong free cash flow generation. But again, on the back of several results now, including last week, free cash flow generation has gone negative. They need to raise capital as a result for a business which is ultimately a utility service with very poor financial returns.